All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I hope you're all staying safe and you and your families are well. During this pretty historic time that we're going through, and there's no other word for it. Historic. It's going to be in the history books in a major way. It is something that will be looked back upon and second guessed in every single way about the responses and what could have governments done better and health organizations done better and people done better. And it's still ongoing, and we're still in the midst of it. And in many ways, you look out and read some and watch some reports. It can be a little scary, and other reports give a little hope. But the reality is we're still in the throes of it, and it does have it has a massive human impact, massive economic impact, and when we talk about a human impact and economic impact, we're talking a little bit about the stock market, how it responds. But let's face it, when it comes down to it, stock market's not the most important thing out there. But in many ways, it's indicative of what is going on out there and how bad something is, or how bad something isn't. And right now, it's pretty bad out there, and so we are seeing absolute history being made in the market where it's pretty much gone straight down this month, down almost 33%. Lost about a third of its value. And during this drop, some of the biggest rallies in history have happened. We have just seen monster rallies. We saw one last night. S&P futures open, and here we go. Friday into the close. Sell, sell, sell. S&P futures open. They get halted right away. Why do they get halted? They get halted because they're down 5%. And halted isn't the right word. What they do is they just make it so futures can't trade below the 5% level, but they can be traded above that level. And so they start to trade back above that level, and then we get this just monster rally on the Fed. And the Fed comes out and says, "Hey, we're going to throw unlimited quantities of money to the markets. We'll step in wherever it's needed, and we'll just spend, spend, spend." And we've talked about this. The governments and central banks around the world are going to be forced to spend, spend, spend. And the Fed announced that in a huge rally. Just put this into context. This is 2,200 up to 2,385. So we're talking about a 185-point rally here. This is what, 7-8% in a matter of minutes. It's unprecedented. It is just absolutely insane in so many ways. And then you look after what the reaction was. Oh, it got sold. And we're basically sitting where we were before the Fed action. As we sit right now, we have Congress here in the U.S. debating a bill that will, help to bail out some businesses and do some other things out there. And it's being debated and contested on certain things. But ultimately, a bill will pass. A spending bill will pass. The details of it can be argued and looked at and all that. But a bill will pass. And, the question is it something that can rescue the markets? During this drop, we have seen the Fed cut rates. We've seen monetary action out of China, out of the European Central Bank. We've seen fiscal action out of China. We will see fiscal action here out of the U.S. We have seen governments take action to try to stem the tide of what is going on, and they will continue to do so. But the chances of one single government's actions changing the course of stocks or putting in a big bottom or top is relatively small. Could it happen? Yeah, it could. Have we seen it before? No, not really. Not really. Not on the bigger drops. In fact, on the bigger drops, typically when we see Fed or government action come in, we do see an initial pop, and then that gets sold and we go down to new lows. So we have a market sitting near new lows, here as we speak, with all this action and all this money being thrown at it. And it's the reality of the situation. We talked about last week, what's it going to take to make a bottom? Well, probably something pretty incredible from a price action standpoint. Last night when we saw S&P futures go limit down in 4 minutes, that's the fastest we've ever seen them go limit down. And I texted my brother. I said, this could be very interesting. If we see markets open, sell off, maybe go down 10%, and then rally back, we could be looking at some sort of bottoming action. But, when we had the Fed step in and we see this type of a rip higher, that's not indicative of bottoming. That's indicative of, continued volatility that's going to keep investors still, on the sideline, worried about what's going on and worried about the severity of the situation that is unfolding out there. And that's what we see. There are no stocks that you can look at and say, well, this stock is safe. Right, this stock is immune to selling. It's the nature of the market when we go through periods like this where, margin calls are hefty. You take a look at Visa. We could argue all we want about Visa being safe and Visa will ultimately go back up and everything else, but there's nothing to stem the tide of it dropping. We could go take a look at Apple and say, Apple should come out of this pretty well and be okay. But at the same time, it outperformed a little bit. And then, Friday afternoon, boom, bye-bye. And we continue to see that. Some of the stocks that have been in that they can't stop going down mode, like Boeing, magically today, okay, it's up pretty big. We're going to continue to see this. We're going to continue to see this type of price action, for the foreseeable future. And it's something where, okay, when do we see that kind of first sustained bounce come in? And do we see that first sustained bounce come in, or is the depressing nature of the numbers that continue to come in terms of the exponential growth of coronavirus cases with the growth in the mortality rate? And I think that's one of the significant factors that is driving the market. It's not just that more people are getting coronavirus. It is that the mortality rate in certain areas is rising, and not just the death toll, but the number of or the percentage of coronavirus cases that are ultimately passing away. And so it's a human tragedy in many ways, and it's something that has the market continued on edge, fearful, worried. Are businesses going to be able to stay in business? We are seeing small businesses across the nation that are just going to have to shut their doors. And, just the reality of the situation right now. Is it recession? Is it depression? Is it all those? Those are debated. You can turn on the TV for 5 minutes. You're going to hear all about, different people's opinions. We're absolutely in an economic depression from that type of definition standpoint and the grinding of a halt of economic activity. But it is something that the markets have never experienced. This is not the 1929, this is not that, time period. This is not the flash, this is not the tech bubble. This is not the financial crisis. This was not created by inequities in the system, by problems in the actual system coming to light. This was created by, something outside that really has transformed human behavior in a way that the markets simply haven't seen, and the markets are reacting to it. And where do the margin calls end? Where do where does the volatility end? So far, there's no sign that it is changing all that much, and in fact, today's actions suggest that it's only increasing. Will there be a rally this afternoon if a bill gets passed? Probably. Will it last very long? I would not be surprised to see a 2, 3, 4 day rally come in. I would not be surprised to see that, just kind of given the exhaustion level of the market where it sits. But I would be surprised if we do not see a little further selling if the data itself, if the coronavirus data itself doesn't make, a significant improvement. I went around the market this morning and just looking at option pricing and said, okay, are there some options where I can get some decent, better pricing? And the reality for me, no, it's still pretty ugly out there from an option standpoint. Are they moving? Yeah, you can get some movement in some options. Bank of America put options. They moved here this morning. Let me kind of pull it up here. I'll show you the weeklies here. Just the at the money, the 18 and a halves. You can kind of see where it's traded. But these put options have traded from 80 cents here up to $1.20 for a big drop in Bank of America. But you can see how they're trading here. Just the ebb and the flow of them. But you have to pay the premium, with the spread on them, and you have to pay the implied volatility loss, should that happen. Now we are not seeing a big implied volatility loss here today, but we are seeing the VIX drop, which is interesting. You see a down market, we see the VIX dropping here. You'll notice the VIX gapped up today, even with the market gapping up. You think, well, how is that? Well, we had a 185 point rally into it. That's just increased volatility. But as the markets have flattened out a little bit here, they have we have seen the VIX come down, but not in a very material way. Not in a way where we go, oh, okay, you know what? It is finally topped here. We are seeing a couple 3-7 crossovers in the market today. On the downside, we're seeing UPS. It's not a trade signal in the same way that it wasn't a trade signal last week on the upside crossover. Walmart as well. And Walmart had an upside crossover last week, wasn't a signal. Has a downside crossover this week, today, not a signal. But starting to see a few more crossovers is a positive sign for potential trading going forward here with them. We also have today Netflix that has a 3-7 crossover to the upside. Now, it had a 3-7 crossover to the upside on Friday before the market sold into the close, but was not a signal as it is coming off new lows here. But you know where I stand with Netflix. It's, to me, Netflix is, there are not a lot of safe havens out there. And ultimately, could Netflix get sold? It sure could. It could be, it could be caught up in a, margin call. You have a couple big investors that just, are forced out, and it could get caught up in that. But ultimately, for stocks that I expect to make new highs in a very big way after this is all said and done, Netflix is, right there at the top of my list. We've talked about that plenty. I would love to trade it. I'd love to get into it right now, but just not a signal. So, okay, well, maybe it'll pull on back for us. Maybe we'll see the implied volatility crush on it a little bit, and get an opportunity to trade it on the next leg higher. That it might take here. So a few 3-7 crossovers. Not a lot of change in the market vibe here. It is still bearish. You can see the bullish percent index. It's pulling back a little bit, but we're talking about it's at 10. That's just an incredibly low number. We put that into kind of history context last week. If we look at the number of stocks above the 7-day moving average right now, it's 52, which is a little higher than what it's been. You have the Amazons, the Chipotles on this list, EOG Resources, FedEx. We have some pretty big names on this. Las Vegas Sands, Micron, Netflix, right? We have some pretty big names on this. And, some stocks that have bounced up nicely, Adobe, for instance, but it's still a very small number. Oftentimes what we will see when the bottom is in, we will see this number jump from below 100 because it's almost always below 100 when the bottom comes. and it'll jump from below 100 to above 300. You'll see kind of this mass movement. And so far, we have not seen anything like that. We will also tend to see, in a lagging fashion, the number of stocks above the 20-day moving average change in a big way. Now, I cannot find any period of time where the number of stocks in the S&P 500 that traded below the or above the 20-day moving average was 5. Can't find any other time. Not the financial crisis, not the flash crash, not anything where we have seen the number of stocks below 20-day moving average be sustained this low for this long. So, what will a bounce mean? Obviously, it'll be brand new territory for it, but typically, once we start to see a mass migration of stocks above the 20, that's a sign that investors will start to jump into a little bit more. But so far, we do not see mass migration above key moving averages. We do not see a significant contraction in volatility or the average true range, and so the ball remains in the bears' court. It absolutely remains in the bears' court, and the volatility, will persist here as long as the metrics continue to look this way, and as long as we continue to see, the data unfolding the way that it is. Thanks for hopping on again. Stay safe, and we will talk to you tomorrow morning. Take care.